Well, thank you, Aviva, for inviting us to do this presentation. I'm Cindy Troston, and I'm here together with my associate Cyrus Commissariat. And we're here from the firm of Troston, Cantor, and Esposito. We're located in Northbrook, and we have enjoyed doing this presentation for the past few years. And hopefully you'll enjoy hearing what we have to say today with all kinds of tax updates. We'll drill down into the latest and greatest of what's happening in the tax world with your filings for 2025 and upcoming tax planning options for 2026. I'm an attorney. I've been with my practice for many years. I've taught law at John Marshall, which is now University of Illinois, in tax in the LLM program. Cyrus is coming to us from Northern Trust. He worked with the ultra high net worth planning area and graduated with his LLM in taxation from Northwestern. So with that, our firm is licensed to practice in a number of states: Illinois, Kentucky, Ohio, and Wisconsin. And for the most part, our firm does taxation work, estate planning, and business transactional. The agenda for today, we're going to be talking about what is new in 2026. We have the One Big Beautiful Bill Act that has made a lot of changes to the tax applications of 2025 and 2026 forward through the 2028 period. We're going to be talking about personal income tax updates, business deductions, which all of us are always anxious to hear more about. Retirement plannings, again, that's something that has changed a bit. So we're going to be updates on those amounts and plan options. Gift and estate tax exemptions updated a little bit this year, and then Illinois specific tax updates. So what's new in 2026? This year, the filing deadline is actually on April 15th. The last few years, I think it was April 17th, April 18th, and this year falls right on time, April 15th. So that's the filing deadline for 1040 returns, 1041 returns. If you need to file an extension, you must do that by April 15th, and then you have a 6-month automatic extension to October 15th. But always be sure when you're doing your filing by April 15th for an extension that the taxes have to be paid by April 15th. Otherwise, the taxes will be late paid and filed, even if you file it under the extension period. We're going to talk about recent tax acts. The big one on the table is the One Big Beautiful Bill Act. OBBBA is how we refer it throughout the presentation and in your outline. As I said, there have been many changes, some changes that have kept existing taxes that came up under the Tax Cuts and Jobs Act and now have been made permanent. Others have been added under the new act and have been either made permanent or have extended certain acts until the next Congress and the next president comes in, and then we'll see what happens next. But at least for the next few years, we know what's going to be happening with many of the tax impacts from this bill. We're going to talk a little bit about working with the IRS. What's new, backlogs and customer service. We talk about this every year. It's been getting better in some aspects and a little bit worse in others. E-filing returns is always the best way to go. If you can e-file your return, it's going to be processed so much faster than if you file the old way on paper. E-filed returns are being processed within approximately 21 days from the date of filing. And usually if there's a refund that's coming from those e-filed returns, those are processed very quickly as well. On paper file returns, processing time is now approximately 4 to 8 weeks. And in our experience, that means you get a letter from the IRS saying we've received your returns, we need more information or something following up before they're actually getting to the processing of that return. So it could be even a little more than that period of time. If you have to file an amended return, we recommend that you do try to e-file your amendment. There are some reasons that you might not be able to do that. Some tax forms still cannot be filed by e-file. If that's the case, then you have to file your amended return on paper. But most often, you want to talk to your tax preparer about getting that e-filed amended return in, so it can be processed faster. Paper filing for amended returns is taking up to 16 weeks. So it's going to languish there for a long time before you hear any action on that filing. The IRS is currently working on returns filed in December for amended returns. So they're within that 16-week period, but there's oftentimes questions that come up and things. You'll probably get a letter saying, we've received your document, give us another 60 days to get back to you, and things of that nature. So e-filing always, always, always is the way to go if you can. I always say be patient with your tax preparer. When we're dealing with the IRS, we have the same problems as any other tax payer trying to get in touch with the IRS. There is what they call a tax practitioner priority line. It might get you a little bit higher in the list of being able to get in touch with the IRS, but not much. IRS publications say that it takes them roughly 3 minutes to answer the phone, but it doesn't mean that after that 3 minutes, you're not going to be put on hold for the next hour. So it takes a long time to get the IRS, and IRS knows
An understatement.
very well.
Oh my gosh.
It's just it's common. But IRS in 2025 has cut approximately 27% of its staff and 22% of its customer service staff. So that means when you call, you're not going to get somebody right away. There is a service that they allow now. Sometimes they'll ask you, do you want to call back? And we always elect to have that happen. And they will give you a time when they will call you back within an hour or 2 hours. And that's usually a better way to do it than just being on hold for that amount of time. There's a new matter coming up that started in September of 25 with refunds. The IRS is not wanting to issue paper checks anymore. So they have enacted a mandate that when you e-file a return, you also inform them of your banking account number and routing number for your refund for direct deposit. If you or your client does not have a bank account, the IRS will send you a letter. If you file your return without banking information, they will send you a letter and they will ask you, why didn't you supply your bank information? They will encourage you to set up a bank account so that they can send you your refund by direct deposit. And if you cannot set up a bank account, within about 6 weeks from that last contact from the IRS, they will issue you a paper check. So it's going to take a long time for that paper check to come. So encourage your clients to give that information with their e-filing so that they can get a direct pay into their bank account. What's frustrating to us, because we do a lot of fiduciary tax returns for trusts, the IRS will not allow a direct deposit refund for a trust. They still issue paper checks.
Okay.
So I don't know what the logic is behind that, but it's a bit frustrating for us. Audits, everybody wants to know what's hot on the audit list for this year. The IRS is still trying to focus on the wealthiest taxpayers. Those over 10 million, which we don't see too many of, are going to be at around 16.5% audit rate. So pretty high. If you have clients in that range, you should advise them that they're going to be subject to scrutiny on many of their filings. The IRS is also taking a look at individual returns with filings of over $200,000 generally. That's in the system, and the system will take a look and make sure that all the ratios are proper on the returns that are being e-filed. Trust fund recovery obligations on S-corps is always high on the list. Are S-corps making proper payroll tax deposits? What we also see, and what Cyrus is going to talk about a little later in the presentation, is under an S-corp, is the owner, the stockholder, also being paid as an employee of that S-corp. And that's high on the list for audits for IRS to make sure that somebody's being paid a salary from that S-corp. Crypto filings, we're going to talk a little bit more about in a minute, but that's high on the list. A few years ago, the IRS imposed a check the box on your 1040 return that asks every person, do you have crypto holdings or do you invest in crypto? And you know, when there's a check the box on a tax return, eventually it's going to turn into a requirement of some kind. And this year, we're going to see new 1099s required for crypto trades and more scrutiny on reporting of digital trading and transactions. Qualified business income deductions. Many of us have LLCs. You might be a sole member LLC. You might have a small practice with a partnership. You have the QBI, qualified business income deductions. IRS is scrutinizing those deductions. Apparently, everybody can try to take advantage of deductions like this, and IRS understands that that's the case, and so they're looking at those closely. And then the final thing is discrepancies between your return that you actually file and the matching tax documents associated with it. So by this, I mean, you're either going to get a W-2 if you're an employee of your practice, or you're going to get a K-1 if you're a partner of the practice, or you have an S Corp, or maybe you have both. The IRS, or sometimes you'll get a 1099 from clients and things like that. The IRS in the past has been very good at tracking W-2 and 1099 matching. They have not been good at tracking K-1 matching. They are getting better. They are getting much better. And so they're matching K-1 income to returns now. And this is something that's kind of slipped through the cracks for many, many years, especially with partnership returns. But now you have to be aware of what is actually being reported on those K-1s, whether it's from your practice or whether it's from your investment income. Make sure that all of those K-1 designations are getting into the proper places on your tax return. And you want to make sure that your preparer is well versed in handling K-1s. Some are, some aren't. Okay.
We have a couple questions.
We have a couple questions. Okay. We love questions.
Yes, there is one question about that 1099 for crypto reporting. Does that apply to NFTs as well?
NFTs.
Yes, it does apply to
There you go.
non-fungible tokens as well.
Thank you.
Yes, you're so welcome.
Are you into crypto?
No, not at all. But if I don't understand it, I'm not going to buy it. But
Okay.
we do have clients that do, and it's
Yes,
good to
we do.
know.
Yes. We deal with a number of trader returns, and they have been heavily into crypto in past years before the requirements were in place. And this year, there is a new 1099. It's called a 1099 DA, digital assets, that's now required for crypto trades by all platforms that are hosting crypto. There may still be crypto trades outside of that don't receive a 1099. They're still reportable, obviously, but the IRS is now tracking crypto trades that are traded on trading platforms. So you had another question?
It looks like the other chats are just regarding the slides.
Oh,
moving.
they're not moving for you guys? Can you not see this on your screen?
The slide right now should be the mileage rate.
Can somebody message in the chat boxes if they
Do you see the mileage rate?
Yes, that's up now. It
Okay.
just came up.
Okay.
Okay.
Oh, huh.
Oh, that's
Okay.
nice.
Well, technology is great till you want to use it.
Okay, I don't think you missed much on the previous slides. They were just the highlights that I've been talking about. In the outline has everything that we're presenting in the presentation, and the slides are more outline-ish. So
You're not furiously writing.
Yes. So next slide for the mileage rates. We all want to know what is the ability to take mileage deductions. So in 2025, for your 25 return, it's 70 cents per mile. And it doesn't matter if your car is gas or electric, it's the same for both. In 2026, it's going to be 72.5 cents per mile. Okay, so that's a lot. So that means you should keep track of all your mileage if you think it's going to be deductible at all, because when you're driving 3 miles, it's $2 already for a deduction. So it's great. You have to make sure you keep track of it though. Upcoming reporting requirements, other than the crypto trades, we have a new 1098 VLI. Vehicle
Loan interest, yeah.
There we go. And it's a new form for reporting new interest deductions on car loans, which has come up under the One Big Beautiful Bill Act. We're going to be talking about that a little later in the presentation, about more details on that. And then last year we spoke about and warned about the 1099-K reporting. That's been scaled back. So it was supposed to be $5,000 per cumulative transactions in a year. Now it's been set at 20,000. So if you recall, this is for people who are selling things like on eBay or on Facebook Market, online, or you sell in a transaction, you sell a car to somebody or something like that. You needed to prepare and file a 1099-K for those transactions if they were over a certain amount. And so for this year, that amount is $20,000. So that exempts most people who are just simply, selling
Back and forth.
an old
Normal,
lawnmower to
right.
somebody, or selling something on eBay. If you're actually in business, though, you will probably have to file 1099-Ks. And if you're registered with a platform, PayPal, eBay, they will probably file those and help you file them for you. Social Security wage base rises from 176.1 to 184.5, so that goes up every single year, and there's nothing we can do about that. Okay, on to some personal tax updates for 2026. Cyrus is going to start.
Yes, I will. Okay, so I know you all can read these wonderful numbers and they're in your outlines. But all we're just going to highlight here is these personal income tax brackets are updated annually to prevent what's called bracket creep. So bracket creep is basically inflation making our real take-home buying power less. It lessens it. So these brackets are adjusted upwards annually to reflect this. So between 2024 and 2025, the brackets were revised upwards 5.4%. So that's reflecting that rip-roaring inflation that we were all experiencing. And then between 2025 and 2026, those brackets were revised up 2.8%. So inflation is cooling and the brackets are being adjusted accordingly. Okay. Now I'm going to talk about qualified dividends and long-term capital gain tax rates. So I know you all are very sophisticated people, but I just wanted to give you a little refresher in case you forgot. So there are two types of capital gains. There's long-term capital gain and short-term capital gain. And all that is, it's just timing. If you hold things for longer than a year, the underlying asset for longer than a year, you get long-term capital gain treatment. So that's if I buy a stock for $10 and I sell it for $11, that $1 of gain, if I've held it for more than a year, is taxed at capital gains rates. So these are very favorable. They're basically income dependent. Yeah, so 0, 15, and 20 are the rates.
A lot of people don't realize that it is a sliding scale. You hear about capital gains rates, 15%, 20%. But some people have 0%. So if you're under a certain amount, as on the slide, it's representing $96,700 for a married filing joint return. You have capital gains, and those are taxed at 0%. So it is a sliding scale. And so when you're then over that 96.7, some of your taxable capital gains are going to be at 15%, but many of them are still going to be taxed at 0%. So it's a blended rate, so to speak, as you go up the scale.
And then of course there's qualified dividends. So we've talked about long-term capital gains. Now we're in the dividend space, right? So dividends are typically taxed at the taxpayer's normal income because that is passive. That's just normal income. But Congress, in its infinite wisdom, to encourage Americans to buy and hold American stocks, they've created this qualified dividend treatment. So instead of having your dividend taxed at your normal income, your ordinary rate, it's taxed at this more favorable 0, 15, 20 regime. So the requirements are it's got to be an American company or a foreign company that's incorporated in the US, which can get a little bit squishier, but it's a general tax presentation. Um, it has to be a regular dividend and not a capital gain distribution. So the how the company is classifying it matters. And then the underlying investment must have been held for more than 60 days during a 121 day period, beginning 60 days before the dividend. Sorry, I went too much in the reads,
Really
but
dug down to that
I
one.
really dug down to that one. But all that is to say is you have to hold the underlying stock for a grander amount of time to get
Okay.
this favorable treatment.
And Cyrus, you may have just answered that. We did have a question.
Oh,
So
sure.
is AGI including the capital gains?
Yes.
Yes.
Yes, capital gains are arrived at before you arrive at your adjusted gross income. Yes, so you would see capital gains reported on a Schedule D, D like David. Qualified dividends, however, are reported either on a Schedule B, like boy, or not reported at all if they're under a certain amount. Or not reported on the form separately.
There it
They're
is.
still taxed, yes.
Okay. Then, sorry, I keep clicking this thingy and it's not changing. Okay. Then there's the additional Medicare tax. So this was referred to as the Obamacare tax. We call it the additional Medicare tax. All this is for high income earners. So for high wage earners, there's an excess 0.9% on those wages. Okay. It's required if you have a salary over 200,000, right? Because you will be in that drag net already. And for married filing joint, that's 250,000 between both individuals. So that means that sometimes couples can be not withholding properly. So this is just something to be aware of. Anything to add?
Yeah, if an employer has somebody making 200,000 or more, there is a requirement on the employer to withhold this additional 0.9%. But what Cyrus is alluding to, you can have two people who are joint filers, married filing jointly, making under that 200,000 each, and still required to pay it when they pay their taxes in April. And that will be assessed at the time the 1040 is filed. So either way, the government's getting their 0.9%, whether it's withheld by the employer or paid directly by the taxpayer.
Okay. Okay, then there is the net investment income tax, which is another sort of parallel tax. Congress, again, in its infinite wisdom, was seeing that high income earners make a ton of their income passively. So they created this parallel tax for high wage earners that is not on their wages. This is on their investment income sources. So, interest, dividends, royalties, think of this passive income. That's what's trying to be caught into this drag net.
Right, so this is non-earned income, and it says here, it does not include IRA, pension, Social Security, unemployment, or wages. So any kind of investment income, it does include capital gains, it does include dividends, interest, royalty income, rental income. So that would be taxed at an additional 3.8% if you are over these amounts. As a single filer, 200,000, as a married filing joint, 250,000. So it's an add-on tax to your already ordinary income tax.
Wonderful. Okay. Oh, these no personal exemptions. In my notes, I have it stinks, and it does, but they're gone.
Well, they did away with the personal exemptions when they started using the standard deductions, and they started increasing them exponentially in the beginning when they started doing this. And those exemptions are still in the background. They could someday come back. But the way we're having the standard deductions increasing, still pretty much big increases each year. Those exemptions have gone away for the most part. On Illinois, they're still there,
Right.
but not on federal.
This was a TCJA compromise, right? They're saying
Correct.
we're getting rid of all these little deductions and these little exemptions,
Yep.
and we're going to double the standard deduction. So that
Mhm.
was the wisdom behind that. Wisdom may be generous. Okay, so this is what we were just talking about. So the standard deduction was doubled under the Tax Cuts and Jobs Act, and that was made permanent by OBA, the One Big Beautiful Bill. So you can read those numbers. Then the standard deduction increases for those who are 65 and older or blind.
Or both.
Or both. You're so right. Yes, anything to
Yes.
add?
No.
No.
So those
Wonderful.
are your standards for this year and for next year. So for those of us who do itemize though, the non-standard deduction takers, we have more things to talk about.
Yes. So for those itemizers, there's the personal medical cost deduction. So if you have medical costs that exceed 7.5% of your AGI,
Adjusted gross income.
adjusted gross income. Sorry, we love our acronyms.
It means something to us, it might not mean anything to you, so we want to explain what they are.
So
AGI.
if you have these significant medical costs, and I think back in the old days, this was more stringent, but now it's been expanded to include basically all forms of healthcare and
Yeah, I mean, insurance is included in medical care, sometimes even over-the-counter medications, prescription medications, dental, eye care, anything that you consider Medicare, caregiver services, long-term care insurance, which does have some limitations on it. But anything germane to medical and health care can be considered, and you should ask your tax preparer, can I take these deductions if you have these deductions and you're going to be itemizing? What we also see a lot of times is when somebody moves into a care facility, whether it be a retirement community or whether it be assisted living, many of those expenses are deductible when you reach certain levels of care. And there are, do you want to talk about the tax letter that comes out from the facility?
Oh, sure. So the facility is tasked then with basically saying, you've paid this much now. Here's what percentage of it is allocable to your care.
Right.
So it'll just assist you in filing your taxes.
Right. So if a client or a parent is in a facility, you'll want to ask that facility for that tax letter. It'll show you what percentage of your loved one's care can be deducted as a medical expense. And we find oftentimes, when people are elderly, they're up in age, they're moving into, memory care and things like that. Almost 100% of those costs can be deductible. So they're quite substantial.
And when you first get in, less, and then as you age and require more care, it increases, and this deduction might make sense for you. Next is the home mortgage interest deduction, which you can deduct up to $750,000 of related interest. The jumbo loans, that's gone away. So if your mortgage was, I believe, over this amount, then you no longer get to deduct the amount that's over the $750,000. The SALT deduction was increased. We're going to talk more about this when Cindy gets to our OBA section. But for those of us in the Prairie State, what a blessing, especially after those Cook County or the Chicago taxes went out. I was not pleased with my property tax bill. You can deduct those high state expenses. And the charitable deduction has also changed. Cindy's going to talk about that. There's for the first time, us non-itemizers actually do get a $1,000 deduction for our charitable donations, and the high income tax earners get a haircut. And basically, they made a threshold that you have to exceed. You have to give above X percentage of your income, and then if you're taxed at the top 37% tax rate, you only get to deduct 35% of what you donated. So there's a little haircut and there's a floor.
And we'll talk about that a little more later. What I do want to get back to though is the SALT limitations, because that's been in the news for now the last year at least.
Right.
Maybe because it was implemented under the Tax Cuts and Jobs Act. We have that limitation of $10,000 for state and local tax. So that means your property tax, your state income tax, all was capped at $10,000. Now for the next few years until 2028.
Right.
Correct?
Congress kicked that can.
Yes.
As they always do.
The can has been kicked. And now for the next few years, the SALT limitation has risen to $40,000. So for those of us who are paying more in state income tax and property taxes, now you have up to a $40,000 deduction for those taxes on your Schedule A. So now, some of us may indeed be over that standard deduction
Right.
amount again.
It may in fact make
Right.
sense.
So you might want to take a look at that, and if you're able to do that, then you want to go back and you want to take a look at those charitable deductions, because now you might be able to take them again. So, it's kind of given you a shift, to be able to get that done.
So this is really more relevant if you have clients in high tax states, New York, California, Illinois.
Yes.
We have a quick clarifying question to
Mhm.
define SALT, please.
Oh, state and local taxes. I'm so sorry, state and local taxes. So this is your state income tax, your local property
Property
tax,
tax,
uh,
sales tax,
Sales
if you buy a large purchase item like a car or furniture or something like that, you can deduct sales tax, things like that.
We have a related question, asking, is there a cap on those SALT deductions based on income?
No, but it would be a deduction overall. If you have $50,000 of income and you have $40,000 of deductions, it's just a wash.
All right.
So no, they're not capped at income levels.
right.
If that's the question, they're not capped.
Good. Wonderful.
Okay,
Okay, miscellaneous item deductions, they're gone. And in my notes, I again wrote stinky, but what can you do? They'll come back. Congress changes its mind.
still in the tax code, but they're shelved for now. They may come back at a future year.
Okay, and then alimony, or spousal maintenance. The timing of when the agreement was executed matters. So prior to the start of 2019, it was not deductible by the payor. No, excuse me.
Yes.
It was deductible by the payor,
Gets confusing.
and then the recipient reported that as income. Now it's flipped. So now the payor does not get a deduction, but the recipient doesn't have to pay taxes. It's just who's bearing the burden of the taxes. And prior to 2019, it was the person receiving it, and now it's the person giving it.
Right. Okay, here we go. The One Big Beautiful Bill
OBA.
Act. We looked into what the site is actually for that Big Beautiful Bill. Nobody ever says what the site is. There is a site, but it's always referred to as the One Big Beautiful Bill.
So
That's it.
in
So
the code,
that's
it's
what's in there.
not called OBA because some fun parliamentary gimmicks that we can email about afterward, if you're interested. But we don't have to get into it here. But
Yeah.
Colloquially, it's the OBA.
Everybody's referring to it as that, so that's what we will do. So you've probably heard that one of the aspects of this bill was no tax on tips. And so we get into the nitty and the gritty, as we call it. A taxpayer can deduct up to $25,000 in tips, but there's some criteria that they have to follow. It must be from a job that customarily receives tips. So if somebody gave me a tip, hey, you did a great job. on
What a
that letter
wonderful
return."
estate plan.
Yeah, and they gave me a tip, I cannot get that tip income waived. I have to report that tip. I'm not in the business of receiving tips generally, or ever. But if you're a waitress, if you're a hairdresser, a bartender, people who normally receive tips in their line of work, that's the people who this is impacting. They must be voluntary gratuities, not automatically added. So you go into a restaurant with a group of 10 people, the restaurant automatically adds a 20% tip to that bill. That's not dischargeable for that waitress to disclaim that amount. It's a phase out for individuals with income over 150,000 and 300,000 for married filing joint. That doesn't mean that both parties have to be engaging in tip income. It just means one person in that married couple has to receive tip income. And it's not exempt from employment taxes. In Illinois right now, it's in the legislature.
Right, Illinois is in
They're
session.
taxing it or not, but we believe right now it is continued to be taxable to Illinois.
So
Okay.
if you're thinking about what do I do about my tax return? Illinois hasn't gotten its act together. They haven't decided if they're going to conform. If you see it in the news, it'll be conform, where they will conform the Illinois tax code to the federal tax code. I don't know, it's anyone's guess. But you still have to file your taxes on time, and so you can strategize whether to
Look at the news and see what's been decided in the legislature, if that's going to be an issue for you or your clients. Definitely be a little circumspect on that. The next one is the no tax on overtime, and similarly, it has some criteria that have to be met. You can only deduct the premium portion, meaning your normal wages, whatever is in excess of those normal wages, up to $12,500 for a single person and up to $25,000 for married filing joint returns. So again, that one person in the married couple might be the only one receiving that overtime. It can be doubled for that person on a married filing joint return. So both people do not have to be receiving overtime. Overtime required by Fair Labor Standards Act and state workers does not count.
Right.
And again, Illinois is going to continue to tax it at this time. Might be subject to change. The next thing that might hit more people is the car loan interest deduction. It did go into effect for the 2025 returns. So if you purchased a car in 2025, you can see if your car qualifies for an interest deduction. You can deduct up to $10,000 in interest on a car loan for a new car that was assembled in the US. So it might have originated in another country. Maybe you bought a Korean car or a Japanese car or a German car, but it was assembled here in the US. That is going to qualify. But again, you want to check with your tax preparer. They will look in. I think that there are lists of cars.
There are lists of cars. You have to check with the dealer.
Yeah.
That point of origin is the point that really, really matters. So you can't just think because, it's a Hyundai, I won't qualify. That's not it. It depends on where it was assembled.
Where it ended up here in
Right.
the US. And there are phase outs, income levels, single filers 100,000, married filing joint 200,000. And it decreases by $200 for every $1,000 of the income phase out. So just to give you an example, if you had a single person, $110,000 of income, instead of a $10,000 deduction, you would get an $8,000 deduction. So it just eats away at it as you go up the income scale. Okay, this is a nice one. One Big Beautiful Bill Act senior deduction. Starting to go into effect in 2025 for those returns being filed through 2028. Taxpayers over 65 years old are getting an additional $6,000 deduction. If you're married filing joint and both taxpayers are over 65, you can have a $12,000 deduction. If only one in a married couple is over 65, you only qualify for the $6,000. Phase out rates for single filers are they phase out completely at 175,000, and for married filing joint at 250,000. It doesn't sound quite right, does it?
Nope, doesn't sound quite right.
Yeah, that's not fair.
Mm-mm.
Okay, and this deduction is I think kind of ridiculous. 6 cents for every dollar of income.
Cindy did that last example off the dome. This one we couldn't quite do that.
6 cents for every dollar over that income threshold. So we put an example here. A single 70-year-old taxpayer earning $80,000 has their $6,000 reduction reduced by $3,000.
$300.
Or $300.
6 cents
Yes,
for every
6
dollar.
cents for every
And this
dollar.
is why we love our tax preparing software.
Sometimes we can all have calculators. Okay. All right. Itemizers. Now here's where we get back to the charitable deduction
Right.
that Cyrus started talking about. Some people started to give more in 2025 because now this income limitation comes into play in 2026. And we were talking about the medical expenses, so being subject to a 7.5% floor on the AGI, adjusted gross income. Now charitable deductions also have a floor. This means that only when you donate over 0.5% of your adjusted gross income can you take that deduction. If you're in the top tax bracket, the value of your deduction is also going to be adjusted down from your 37% tax bracket to your 35% tax bracket. And that adjustment is going to reduce the amount of your charitable deduction. Some good news though, on the other side, and this is just for itemizers. This is just for itemizers. For non-itemizers, on the bottom of the slide, beginning in 2026, you're going to be able to take a $1,000 deduction for a single taxpayer and a $2,000 deduction for a married filing joint taxpayer in what they call an above-the-line deduction before you arrive at your adjusted gross income. If you have receipts for those deductions, you have to have a tax letter or canceled check and a tax letter. Tax letters are the best to
Right.
get back from the charity itself. But you have to donate to a qualified charity, and it cannot be a donation to a donor advised fund. It has to go directly to a charity. And when you have an above the line deduction, it reduces what you have to pay to the state, because the state income tax level starts with your adjusted gross income on the state income tax return. And it will reduce what you're paying for Medicare expenses. Your annual premiums will be lowered. So this is great. If you have charitable deductions and you can take without itemizing up to $2,000 on a joint return, it's really benefit to the charity and to the taxpayer.
This really was meant to encourage, the spirit of this was us little people really do deserve to get our charitable, we should get a reward for our charitable deductions. So,
And we want to encourage donations. We
Right.
want to encourage people to donate to charities.
right, because there was this fear that the ultra wealthy are going to stop donating because of this haircut and floor. So they wanted to make sure that, maybe us little people will make up some of that. Let's see if we do.
Let's see. Hopefully it will continue to be a charitable nation. Okay, so everybody's heard about this. Nobody knows what they are. Okay. Trump accounts, okay, love it or hate it, okay, they're here and they have some good potential. For American children born between January 1, 2025 and December 31st, 2028, the good thing is that the Treasury, the US government, is going to contribute $1,000 to each of those children's accounts. You have to take an election on the tax return in the year your child was born to be able to get that government funding. However, anybody listening here today can set up an account, a Trump account, for a child who's under the age of 18. They will not be funded by the government, but you can contribute yourself to these accounts up to $5,000 a year. And it's not a tax deductible contribution.
Like a
to the account.
529. So
Yeah.
we got to keep our buckets separate.
Right. So, but you can contribute for a grandchild, for a child, up to $5,000 per year for that child. And when the child turns 18, that account turns into an IRA for the child. So they're kind of cool.
They're kind of
So
cool.
it's kind of like a Roth IRA
Right.
that turns into the IRA for the child. And when they're 18, they can take the money out for a home purchase, an education, or starting a business.
Which is really cool because the 529 limits you to education expenses.
yeah.
So this,
So-
these are flawed instruments, and you just got to take advantage of every single one.
They're good things to look into. They're good things to compare. What are your options for contributing to an account for a child or a grandchild? How do we advise our clients to take advantage of this? I would definitely say, every client should take advantage of a new child.
100%. Get
Now-
that free
That's
$1,000.
free money
That's free money.
for the child, and it'll be there until they turn 18, and then they can decide what they're going to do with it.
And
So,
the flaw with this program, though, is it's an opt-in system, not an opt-out system. So you really have to be proactive and encourage your clients who had babies. This is important. Really got to think about getting that free grand.
exactly. Okay, Cyrus, on to other children.
Okay, on to other children. I'm talking about the child or dependent care credit. So what this is if you have expenses related to childcare or dependent care, the federal government says, okay, we'll give you a bit of a break for that, and we'll reimburse you currently up to 30, well, actually in 2026, so I guess currently. In 2026, you get up to 50% of that cost reimbursed. In 2025, the max is 35%. Okay. So this is non-refundable, which is the huge difference between the child tax credit. This one is non-refundable, and the percentage of compensation is reduced as your income goes up. So there are income phase outs that we did not get into here.
They are
but
in your outline, though.
they are in your outline.
Yes.
Anything to add?
Yeah, so this is a child care credit that's available, or let me back up a minute. It's child and dependent care
Dependent
credit.
care,
We want to
right.
include dependents as well. And I'll talk about that in a minute. But anybody, no matter what your income, can avail themselves of this credit. So if you're making $2 million adjusted gross income, you can still receive this credit. It would be 20% of your child care
Costs.
costs. For low income earners, it does in 2026 go up to 50%.
Right.
2025 was capped at 35%. So that's a great plus for low income taxpayers that has increased quite a bit. For dependent care credits, this would come into play if you have an adult child who's still dependent on you because of a disability. If you're caring for a disabled adult parent or some person who's in your household who's a dependent and that you're paying for while you work. So that's another criteria here. You and your spouse have to both be working to qualify for this credit. Okay.
Okay, then we're talking about the child tax credit. So we were talking about the care credit. This is the child tax credit. So this is for children under the age of 17 years old. This is a non-refundable credit. There is a maximum credit of $2,200 per qualifying child, and the full amount is available if your income is less than $200,000 as an individual, $400,000 as a joint. Anything to add about it?
There are other dependents as well. If you have again, an adult child or a dependent parent who are also being cared for, subject to these same income levels, you would receive a $500 credit instead of the $2,200. So,
Not as generous, pretty useful.
well, it helps.
It helps.
It helps. Okay, education credits. I'm kind of on the fence on education credits. There are two education credits that are available for taxpayers, and these come into play if your child is in college, oftentimes. For yourself, we'll talk about that a little more in a minute. But the first one is an American Opportunity Tax Credit, and it qualifies for the first 4 years of post-high school education. So only for the first 4 years. So it doesn't apply to a master's level or beyond, bachelor's level work, or I don't know if it would qualify for trade school, actually. I think it does.
I think it does.
But associate degree. 100% of the first 2,000 and 25% of the next 2,000 for a maximum of 2,500 annually. And $1,000 could be refundable if you end up with a tax refund on your return. It does phase out at certain income levels. They're stated here, 160 to 180, totally phased out for married filing joint. The next education credit is the lifetime learning credit. And these two are kind of interchangeable in the beginning of the first 4 years. But this one goes on, and lifetime learning is the key, lifetime. So let's say we decide to go back to school and we're taking a course. We, as older people beyond our bachelor's degrees, can take advantage of this credit. And we have to be enrolled in an eligible institution. We've had some clients who have said, my student is studying overseas. Oftentimes, universities out of the country do not qualify as an education credit eligible. Taking higher education courses to get a good degree or otherwise educational credential. 20% of the first 10,000, any post-high school education, bachelor's, master's, PhD, whatever you want to do. And it's a little broader where tuition fees, course material qualify for the credits. I believe on the American Opportunity, it's only tuition. And phase outs are at the same levels, and it's limited to $2,000 per return. And you can take it every year for the next 20 years if you're taking courses or more. It never expires. You can take it every single year. So later on in the conversation, when I'm talking about business deductions, I'm going to talk about education credits for a business owner. And those are different from the credits that I just spoke about. So I'm going to hand it back over to Cyrus for earned income tax credit.
The earned income tax credit is a deeply flawed policy tool, which is meant to reward work. It's meant to reward the taxpayer whose income gradually goes up with a refundable credit. That's why these things are so valuable, because you can get it back even if you don't owe any taxes. So it reduces the tax owed and increases your refund. It's for low income earners, and my great qualm with this EITC is it's administratively quite burdensome. We talked about high audit rates. The EITC is a recipe for a high audit rate, because what some unscrupulous tax preparers do is bump up their clients' income to artificially show an increase in income and therefore an increase in their refundable credit. So these are scrutinized super heavily, and taxpayers frequently get into trouble. But it can be a really big blessing for low-income families that really rely on this money. So,
And just to combine what we talked about the IRS's new policy about making sure you get a tax, an e-filing with a bank account, routing number and account number. A lot of families who are in this area of income, level of income rather, might not have a bank account. And so they're going to be stuck again with a change in IRS policy of not getting their check. These returns are usually the returns that are filed like right on filing day. Filing season opened in January. These returns, I can assure you, are the first ones to be filed. And now they're going to be stuck for weeks before they're able to get their money. And people who are really
dependent
on this money are really going to be suffering from this.
So sorry, that was a bummer. Okay, now for all of these clean energy credits, that's the next section of the presentation. Not going to spend a ton of time on it because these largely went away. Congress has clawed back a lot of this money. So this federal electric vehicle credit went away September last year. It's actually how I leased a car. Just a heads up, took advantage of that. Isn't that fun?
Good.
Putting our tax use to use.
And you got in before September 30th, you might be able to take your deduction for 2025.
But it's gone away, and what can you do? Just, keep the receipts if you did that. Next is a solar tax credit. Again, this went away December 31st of 2025. So the thing that's annoying with these energy credits is you have to keep in mind the dates. Timing always matters with tax, and it really matters with these.
For these taxes, though, for these credits, be sure to have receipts from the provider, from the contractor, because if you want to flip to the next slide.
Sure.
On your energy property credits, some items that are installed may qualify, some may not. So you want to make sure that the contractor is certifying that these pieces, like the doors, exterior windows, qualify for the credits.
And there's this with solar too. This was the other, I'm going to go back one. With solar, residential solar had to be put into operation by December 31st of last year, but commercial products have to begin construction by July 4th of this year. And if construction begins after July 4th, it has to be put into service by 12/31/2027. So a lot of these have gone away, but there's still some opportunity for commercial products or projects, excuse me.
Okay, business deductions. This is always the fun part. Okay, so many of us have maybe have an LLC, maybe have an S corp, partnership. Everything we're going to talk about now is germane to any kind of entity that you have. So they might be reported on different returns, but all of these items that we're going to be speaking about would apply to all of your business deductions. So to start with, income, what should be reported? Everything, okay? If you receive 1099s from clients, you're not going to receive a 1099 from every client. The IRS, when they look at your documents, when they're auditing, they will look at your bank records. How much have you deposited throughout the year? If those are all business deposits that you've made throughout the year, that's your gross income to start with. So that's what should be reported on your line 1 of whatever the return is that you're filing. Car expenses, actual expenses versus per mile deduction. You want to talk to your tax preparer to see what kind of deduction you should take. Once you buy a new car and put it into service and you start electing which one to use, whether it's per mile deduction or an actual expense deduction, you're kind of stuck with that choice for the life of that car. So if you buy a car and you know you're going to use it over 50% for business use in your practice, you're going to want to have actual expenses. And for that, that means fuel, oil changes, car washes, insurance, lease payments, whatever else you're paying on for that car. If you do per mile deduction, you just get per mile deduction. You don't get the extra deductions for insurance or gas or anything else. But no matter what option you choose, you do get deductions for all of your parking and tolls. So I always caution you, if you're going to be taking any kind of a car expense, whether it be per mile or actual, you always have to keep track of all of those miles. So have a logbook in your car, download an app that'll allow you to track your miles from day to day and write down where you went, whether it was commuting miles or business miles or personal miles, because that is what the IRS will look at in an audit. They will look for that mileage record book. And if you do not have it, that mileage deduction will be disallowed in its entirety. Even though you knew for a fact you drove everywhere, you just can't prove it because you don't have a mileage log. So the IRS will disallow it. Depreciation. We all have something in our businesses that is depreciable. We have a computer, we have a phone, we have a car, we have office equipment, we have office furniture. All of those are depreciable assets. And there are different ways of depreciating those assets this year. There's the Section 179 deduction, which essentially allows you to buy an asset. Let's say in 2025, you bought a new computer. A Section 179 deduction allows you to take the whole cost of that computer as a deduction in 2025. Bonus depreciation is a similar application. You could take a computer and take a 100% bonus deduction. And again, you get to write off the whole thing in 2025. If you take depreciation for that computer, you're going to be depreciating it over 5 years. That means you're going to be taking a percentage of that cost that you purchased in 2025 and deduct it over those 5 years. This MACRS, another acronym we use, stands for Modified Accelerated Cost Recovery System.
Hold on.
It superseded the accelerated cost recovery, which I think went back to 1986 tax code. But it says that you can take certain percentages each year over that 5-year period. They're not an equal amount every year. So there are charts where you would figure out how much you could take.
We do have some questions about this slide. Related question, car related. Are car washes deductible?
They are if you're taking actual expenses. Yes. And I gave the example, if you're using your car over 50% for business use, 50% of your car wash is going to be deductible. If you're using it 80% for business use, 80% of that car wash is going to be deductible. So it's a pro rata percentage of those actual expenses.
And then we did have a hanging question on the senior deduction. So to the personal side. But the question is to explain the extra $6,000 deduction for seniors. Is that only for seniors who itemize?
No,
No.
it's not an itemized amount. So it's a new form, and it'll be a deduction on that form. Okay. Travel and meals. It's changed a little bit from 25 to 26. Meal deductions are still at 50% for most meals. And what this means is if I go out to lunch and I have lunch by myself, I can't take that as a deduction. If I go out with Cyrus and we go out and we talk business during lunch, I can take a 50% deduction for my cost of paying for both of our lunches. If you are traveling you can take a 50% deduction for that travel, if you're eating by yourself, and you're staying overnight. So if I drive up in Milwaukee and I'm gonna see a client the next morning and I stay overnight in Milwaukee, my breakfast, lunch, and dinner, eating even by myself, I can take at 50% deduction because I'm there overnight. If I'm in town, I drive to Chicago, I have lunch with somebody, I drive back to my office in Northbrook, that is not qualifying me for having a meal by myself. Okay. So that's the test. Overnight, you can eat by yourself. If you're in town, you have to have a chaperone. Okay. For holiday parties and all employee meetings, usually can deduct those expenses at full expense. In 2026, 2025 to 2026, if we're asking employees to work late, sometimes you order in a pizza or you get Chinese or something, usually you can take those as a deduction. Now you can't in 2026. They're not deductible. You can't take those. So you have to tell your employees bring a brown bag and you can take your lunch at your desk. So a little bit of a change there, but not a lot. In past years, entertainment expenses used to be deductible. They are still not deductible. So you cannot deduct anything for taking somebody out to a game or to a concert or something. Still not able to deduct those things. That might come back in future years. We don't know. Office and home. A lot of us might be officed in our homes. During COVID, a lot of us went home and were working there for a couple of years and never went back to an office. If you are your own business in your home, you can take the office and home deduction. If you are an employee of your own business or somebody else's business that has a location other than your home, for instance, I'm sitting here in my Northbrook office. I do have an office in my home, but I cannot deduct it because I have my office here. So you can't have an office in two locations and have an office in home. It has to be your sole place of doing business, usually for self-employed individuals or a person who has no other office. And it has to be used exclusively for your business. So if you have a home, you have an extra bedroom, and you're using that for your office, that space as a percentage of your home is deductible for all of your typical home expenses. Your property tax, your home mortgage interest, your utilities, your home insurance, as a pro rata percentage of that office space that you use for your business. You can take those deductions on your office and home business reporting on your tax return. Any questions on that? Usually we do.
No.
Okay.
Everyone's clear chat right now.
Great. Okay. Education, which I wanted to pick up on from those education credits. When we are in business for ourselves, either a sole proprietor or an LLC or a partner, we can take our own education and take it as a deduction as a business expense. So what does that mean? The IRS says that if you do not qualify yourself for a new trade or business, you may take your education expenses as a business expense. So for instance, Cyrus here has an LLM. He wants to go out and get a second LLM. He's free to do so.
Perish the thought.
Take it as a business deduction if he has his own practice and wants to do that. And it would be a brand new degree with a total write-off for business deduction. He's an attorney, but when he starts, and he's an attorney at the end, he has not changed his trade or business, so therefore it becomes a tax deduction. If he wants to become a botanist, if he wants to go and open a floral shop or something like that, that's a new trade or business, and whatever coursework he takes for that would not be deductible in that manner. He might be able to take the American Opportunity Tax Credit or the Lifetime Earning Credit, but not as a business deduction. For employees, an employer is allowed to pay up to $5,250 per employee for their education and not have it taxed as income to the employee, but it is a business deduction to the employer. So if they want to have somebody go out to get another certificate in a certain area or something, or even additional coursework, they can have that paid directly to the university or college or school, not taxable to the employee, but deductible to the employer. And we can also do that now for student loan payments. So if you want to add that as an employee benefit, your employee has a student loan, you can give up to $5,250 to the student loan provider, not to the employee, but to the provider, and have it not count as income to the employee, and allow it to be a business deduction to the employer. Insurance, all business insurance is deductible for your trade or business. Health insurance is deductible if you are a sole proprietor or a partner on your 1040 return. If you are an S corp or a C corp, the corporation would generally pay your healthcare costs, and it would be deductible there. Okay, qualified business income deduction. This was made permanent under the OBBBA Act. This is the 20% deduction that's afforded to most businesses, phased out over certain taxable limits, and those are set forth in your outline. One of the things that the IRS is catching is that a lot of people are reducing their self-employment tax when this 20% reduction is taken into account. It does not lower your self-employment tax. So if I made $100,000 in my trader business and I took my 20% deduction, $20,000, I only have 80,000 of taxable income, but I have to pay self-employment tax on the whole 100,000. So it doesn't get you away from having to pay that self-employment tax. This is available to sole proprietors, LLC sole members or partners, and S corp shareholders. And these, okay, and the 1099s, well, a few years ago, the IRS reenacted or reconstituted the 1099 NEC. It was there for many years. Nobody ever used it. Everybody always used a 1099 miscellaneous, MISC. Now the IRS is essentially mandating the use of the NEC 1099. So the requirements for this is if you are in a trader business and you have vendors who are supplying you with services worth over $600, and they, as a vendor, are either a sole proprietor, LLC, or something other than a corporation, we are required to provide 1099s, 1099 NECs to those providers. So we, as the business owners, have to provide these 1099s to our vendors. Our clients have to provide 1099 NECs to us if we have been receiving over $600 from them. So you'll probably get a slew of 1099s coming in the door because people have been asking you to send their W-9 out to them so they know your tax ID number and things. We've been getting a stack of them in the mail. But we're required to give those 1099s every year for $600 or more. The MISC 1099 is still around, and that's where rents are reported, or if there's a healthcare provider that's being paid. We administer estates and trusts, and sometimes we will have a healthcare provider who's being paid from one of those entities, and we will issue a 1099 MISC to those providers as a healthcare provider. Either form can be used for legal services, but most people these days are using the NEC for legal services being provided. And then we also have, which Cyrus is going to talk about in a minute, retirement plan and employee benefit deductions on your business expense sides. Okay, so now over to Cyrus for
Yes.
Or we have a question.
We did have
a question.
We did have a question about the student loan deduction, asking about what about if the employer pays the student loans of an employee's child? That would qualify.
That wouldn't qualify. It has to be an employee.
Okay.
Yeah. That would be in some way compensation to the employee, maybe as a bonus or something like that, but it would be income to the employee. And if it's compensation to the employee, it would be deducted to the employer, but it would not qualify for that exemption. Okay.
Thank you. Great questions, everybody.
Sure. Yeah. Love the questions. Okay, Cyrus, retirement plan.
Retirement plans. Okay, just so everyone has it straight in their mind, 401ks, those are from your employer. Okay, so when we're talking about 401ks, these limits apply to you, what you can squirrel away from your paycheck, and 401ks can either be Roths or traditional. So pre-tax or post-tax dollars, you decide. And then there's a max of $69,000 last year, between what the employer and the employee could pay. However, there was this additional $7,500 catch-up for those employees over the age of 50, becomes $8,000 in 2026.
It's very confusing. In the outline, I just wanted to point out, though,
Yes.
there was one distinction we needed to make. On page 18 of your outlines, we incorrectly put 23,000 instead of 23,500 as we have on the slide that you're looking at right now, and 24,000 instead of 24,005. So we apologize for that, but that is
The
the
correction.
correction.
Okay. Okay, now we're setting aside 401ks. That's all. Sorry, I didn't mean to. We're setting aside 401ks, and now we're in the land of what I, as the employee, can control, administer, contribute to on my own side. Okay, so this has got nothing to do with the employer. So for your own retirement, you can contribute a max of 7,000 for this year and 7,500 next year. Or no, I'm so sorry. Previous year, 7,000. This year for your tax planning, 7,500. And there are Roth phase outs. Basically, you can't contribute this $7,500 this year if your income is in this range 150 to 166. It gets reduced on a pro rata basis. Okay, we didn't put that in the slides, but take my word for it.
We also want to make mention that IRA contributions, whether it's a traditional IRA or a Roth, they must be made by April 15th. So for 2025 contributions, you do have up until April 15th to make those contributions for 2025. You can also make a contribution right now for 2026 if you choose to. So you have to make that election. What year are you wanting it to go toward? Okay.
Was there a question?
Yes, we do have a couple.
Oh, a couple. Thank you.
First question is, how are Keogh accounts treated? And then this might be a follow-up on that. For maximums, is that for earned income, or do pensions and Social Security get added in?
What was the last question again?
For maximums, is that earned income, or do pensions and Social Security get added in?
For these phase-on amounts?
Yes.
Pensions and Social Securities would be added in, but only the part of Social Security that would be taxable. So Social Security is a graduated amount that's taxed, and it can be taxed up to 90%. So part of it is not going to be taxable, but whatever is on the tax return that qualifies for taxable income is going to be part of that phase-out amount.
And then the question on Keogh accounts.
We're going to have to get back to you on the Keogh accounts as far as maximum. We didn't have that in the outline. So we will provide that to you if you want to give us your email after the event, and we're happy to do that for you.
And then a separate question is there an income phase out for Roth 401 accounts?
Yes, there is. Yes, there is. For Roth 401k?
Yeah.
Oh, for Roth 401k. No, there is not for Roth 401ks.
No income phase out
Yes.
for Roth.
They're subject to the same contribution rates as the 401k.
Okay. And then we have a separate question that says, please comment on AMT.
AMT. Do we have a slide for AMT? AMT is in the outline. I don't know that we have a slide for the AMT. That's another acronym. It stands for Alternative Minimum Tax. And this is the tax that is kind of layered on top of the ordinary income tax. So we talked about the additional taxes, the Medicare tax and the net investment tax earlier. Those are add-ons to the income tax. The alternative minimum tax is what they call a parallel tax that was enacted, I think it was back in the 80s, for high income earners who were receiving a lot of non-earned income, passive income, royalty income, interest, dividend income from investments. And it took away certain items of it took away certain abilities to deduct items on standard deductions, or no standard deductions, itemized deductions, such as depreciation items, tax items, interest items, and would add that back in to the gross income of the taxpayers to add an additional tax called an alternative minimum tax, so that higher
Earners.
higher taxpayer reported income, I'll put it that way, because they're not earners,
Right, 'cause-
would be taxed at a similar rate to somebody who was an earned income earner, who was actually being taxed at higher rates than
Those passive
high-
income.
passive income taxpayers. And for many years, because of inflation adjustments and non-inflation adjustments, it became kind of out of whack, and it started impacting a lot of middle income taxpayers. And now they've tried to straighten it out so that it's really now only affecting higher income taxpayers. But this year I was reading more about articles that are saying that it is going to start impacting middle income taxpayers again, until Congress really adjusts the formulas and straightens it out once and for all. So it's a parallel tax universe is what it really is. I hope that answers your question.
Yeah,
And-
that could be its own seminar. It's not intuitive.
Yeah, it is not an intuitive tax. Retirement plans, just a couple things. To talk to your tax planners and preparers and financial advisors about. There is a backdoor Roth IRA, and this allows you to make a non-deductible IRA contribution if you're over those limits where you can make a contribution to your IRA that's deductible. And you report it as a non-deductible IRA contribution on your tax form. And you can then take that and convert it to a Roth. So even if you're over the taxable limits to be able to contribute to a Roth, you're able to do that through what they call this backdoor Roth IRA. And you're not paying tax on that conversion because you're converting a non-deductible IRA, which was paid for with
You
after
just
tax
paid,
dollars.
you've already just paid tax. So the timing is essential.
Yes, so timing is essential. And then the mega Roth conversion, I say don't try this without a knowledgeable advisor. This is for 401k conversions, where you can contribute additional money to your 401k and then convert that over into a 401k for a Roth. But your plan document has to be able to allow this to happen. So some plans may allow it, some plans may not. So again, talk to people before you even attempt to try this. So, okay, next slide. Qualified charitable deduction. A lot of us are probably doing this. We receive required minimum distributions. I'm not doing it yet, but when you're receiving a required minimum distribution from your IRA, if you're over 70.5, you're getting a required minimum distribution whether you're working or not. And you have to do something with that money. You're either putting it into an investment account, into your bank account, paying bills with it. You have the option to say, I don't really need this money right now. I would rather just have it given to a charity directly. And you can contact your administrator of that IRA and say, I want you to donate to the Decalogue Society. So instead of receiving your R&D, they take part or all of that amount and transfer it directly to the Decalogue. You don't pay tax on that income, but you don't get the charitable deduction either. But usually it's a better benefit to not have to report the income in the first place than to get the charitable deduction. So it benefits you and it benefits your charity. So it's a great way to do it for your required minimum distributions. And as I said before, it also reduces your adjusted gross income. So your state income tax is going to be lower and it reduces your Medicare premium amounts.
Okay, Secure 2.0. This has been out, so I don't want to bore you with some old information, but there are some things that apply in 2026. And that was, I believe, the catch-up contributions. Oh, it was I'm so sorry. It was mandatory for taxpayers making catch-up contributions, they have to be made on a Roth basis. Nope, I'm so sorry, traditional basis. What was really cool about Secure 2.0, this was really relevant for me and perhaps for other young people who have exited their higher education. A 529 historically could only be used for education, and then you would transfer it over to, I mean, it's either going towards your education or you transfer it over to a qualified person. Now, what's really cool is you get to convert your 529 to a Roth if you would so choose. So this is something I'm considering. Do I give my 529 to my kids, or do I put it towards my retirement? So that's pretty cool stuff.
We're gonna speed it up a little bit, because
Yes.
we're coming up to the end of our time allotment here.
Okay, we'll
So let's
skip
hit
past
some
some
highlights.
extras. So we'll do the gift tax exemption. That was pretty cool.
This is always cool. The annual gift exclusions, 2025 and 2026, they're staying at $19,000 per person. That means that I can gift $19,000 to Cyrus and to Brandon. Well, I can't because they're employed.
Right.
But to anybody else.
Okay.
And if I'm a married couple and my husband wants to join me in a gift, we can contribute $38,000 to each person. So it's a great way to reduce the taxable estate, gifting to children, to grandchildren, to others, to reduce that taxable estate. And the federal estate tax and gift exemptions are going up to 15 million in 2026, 15 million per person at the federal level. Still stuck at $4 million for Illinois estate tax exclusion amount. So our office does do a lot of estate tax returns because of the Illinois tax. So unfortunately, that's still there. Okay.
And I just actually want to make sure though, I just want to make sure people understand the gift and estate tax, how it actually works. You can give $19,000 per year to each person. But if you go over that $19,000, that doesn't mean I pay tax on what I've gone above. What that means is that, let's say if I give $20,000, that $1,000 then is subtracted from my gift tax exemption. So instead of having 15 million, I'll have 14,999,000
When you pass away.
when I pass away.
Yeah.
So people, I think, sometimes get confused. This is not going to touch the average Joe Schmo. This is really for really wealthy people.
Okay,
Now-
Cyrus, I think people want to hear about the FSA and HSA,
Yeah.
so we'll do that, and then I think we'll skip over to maybe a couple of Illinois things and then the foreign.
Okay.
Okay.
Cindy has cautioned me to not spend too much time on this because I love HSAs. HSAs
Could
are
talk for 12 hours.
I could talk for 12 hours about HSAs because of it's tax-free times 3. So you get the tax deduction when you contribute it. All of that growth is tax-free in that account. I have an HSA. I've invested my HSA. It has grown. All of that growth is tax-free. And all the income generated off it, tax-free. And when I take it out, so long as I use it for a qualified medical expense, tax-free too. So that's really exciting. That's really big savings. So that's an HSA, and you can only get an HSA if you are enrolled in a high deductible health plan. Okay, so that's the HSA. Now the FSA is for other insurance plans, and this one is really useful and not useful, right? Because it's not useful because it doesn't roll over like the HSA. So you got to spend these dollars. It's use it or lose it by the end of the year. But it does reduce you do get that tax break. So good things. Oh, and then there's also this FSA dependent care contribution. You can contribute $5,000 per household for dependents. Illinois, not a ton of changes, 4.9% flat tax rate. We don't have a graduated tax here. And then these are the exemptions for this year. For Illinois, one cool thing, if you get a dividend, right? So if you get income from a stock that you own, if they pay you out a dividend in these 5 companies, because Illinois has said, wow, these are such useful companies to our state, you get to take that income out of your taxable income for Illinois, just for Illinois. Now, historically, you had to file these returns on paper. We got to let you know what they're going to do for this year.
2025, if they're allowing e-filing for this, but it was an additional form to your Illinois 1040 return, and they would not allow e-filing for it. But if you have larger investments, as some of our clients do in these stocks, it was well worth filing it on a paper return, so to get the deduction.
So for the 529, Illinois does Bright Start, which is I actually looked this up. So there's Bright Start and Bright Directions. Bright Start is a plan that one manages oneself, and Bright Directions is one that the state, I think comptroller is in charge of choosing the assets.
Oh,
And
okay.
so you get the choice of either or. And you get the deduction in Illinois. So these are really valuable. Now, bear in mind with 529s, you don't have to be a resident of the state in which, and the child that you're giving this for doesn't have to be a resident of the state 529 plan that you're using. Illinois does really have a strong plan. I'm not shilling for it, but theirs is pretty good. Utah's pretty good, but you can shop around and see which one it works for you.
Okay, the last official slide here is the FBAR, foreign bank and
Foreign bank
Bank-
account reporting.
reporting. And this is a document that's filed with your 1040 return. It used to be a separate filing, but anytime you or any of your clients have a foreign presence with a bank account holding over $10,000, and I have in bold here, on any day during the calendar year, you have to file a Form 114. It's filed with FinCEN, which is Financial Crimes and Enforcement Network. When this first started coming out, it was a criminal act if you did not file this. Now it's more of a civil act. Criminal is held for egregious types of evasion. But a lot of people get caught with this because they might have a foreign asset that they sell and they put into a bank account before it's wired the next day. There's a FinCEN requirement to file that Form 114 to report that bank account. Some of our clients have investments because they're dual citizens in other countries. Some people might have foreign pension accounts. They've moved here to the US, got US citizenship, but they still have that overseas account. That's a requirement to report every year. Some of us might have people who are relatives who gratuitously put us on a bank account in another country. Now we've got a reporting requirement. This is not a tax. It's a reporting requirement because the IRS wants to know, where do we have foreign assets? Where are they being held? Interest and dividends on any of these invested assets would be reported in the same manner as a US investment. But the principal of that account, the money that's in that account, has to be reported. The same as foreign assets that are transferred to the US. There are certain reportable transactions. If you're receiving a gift from somebody from overseas and it's over a certain amount, those items have to be reported as well. Doesn't mean you're paying tax on those amounts. It just has to be reported. So if you have any nexus to overseas accounts or assets, or receiving transactions to or from, talk to a knowledgeable tax preparer to see if you have any reporting requirements for these transactions. So with that, we only have a few minutes left. We did take questions throughout, so I hope we answered a lot of your questions. But if you have other questions, please feel free right now to put them in the chat box.
Okay.
And Brandon, do we have some?
Yes, we do.
Okay.
So we do have a question on the 529s.
Yes.
Is there a cap on how much one can pay into a 529, irrespective of the deduction amounts?
That's
Yes.
a great question.
What the way it's tied to that 19,000 that we talked about earlier, that present interest gift. You don't want to get too much into it, but I think it's really fun.
It's fun.
It's fun stuff. It's just fun stuff.
Well, you want to talk about the front loaded?
Right. And I had wanted to tell you all about front loading. So it's 19,000 because of that annual gift tax exclusion, but you have the option of front loading 5 years of contributions into a 529. So instead of that, reducing your lifetime gifting amount, it doesn't, which is really cool. If it's
We
we can go overtime to answer all the questions. Sure. So yes, the limit is the 19,000, and I forget the math. What is it? It's 19,000 times
95,000 for the front loading for one person. But if two grandparents want to couple together and contribute to a grandchild's 529, it would be 190,000 front loaded. So
19,000 per child. 19,000
Yeah.
per child.
Yes. So
19,000 per child per person giving it.
yeah.
So I have a 19,000, Cindy has a 19,000.
So it's great for the child, it's great for estate planning purposes. It's a great option. Question.
So then going back to the Roth IRAs,
Mm.
so one person asked, if I make maximum deposit to my SEP, SEP, can I still deposit maximum to a Roth IRA?
Depends on your income levels. So you would have to see what your income levels were that year. Because you may vacillate back and forth. You know, 1 year maybe your income level is lower and you would have the ability to contribute to a Roth. Sometimes you would have more income and you would be contributing to your SEP.
And don't get too confused by all these acronyms. SEP is just the small business one. 401k is the employer-employee one. There's a nonprofit one, which I forget. I forget the code section.
Okay.
Okay, going back to the alternative minimum tax.
Oh my goodness.
Okay.
Just a question as to
Okay.
whether that applies to corporations or just individuals.
It applies to individuals, and we have a lot of trusts that are caught with alternative minimum tax because the trust levels are much lower than individual levels, so oftentimes they have alternative minimum tax. I'm not sure about corporations.
We don't do
I
a
would
ton
have-
of corporate
I would have to
returns, I'm
look.
sorry.
Let's see. Scrolling up, I know we missed one in the beginning. This is more state related than tax related. But
Estate related?
yes.
Okay.
So
Give it a
it's-
try.
This is Brandon's bailiwick.
Move back here. Okay. Since you mentioned you did estate work, okay. If an estate was closed in 2024, final return, and a check was received in 2025 for a settlement in a class action
Oh my.
that the deceased probably didn't even know about, and the check is very, very small,
Whoa.
is there a way to deal with that check without reopening the estate?
Oh my goodness. Well, I would want to know how much is very, very small. If, are we talking about an estate tax return or an income tax return?
I think they're just asking if probate needs to be reopened to handle the check, as in like get it to the beneficiaries. If it's payable to the estate.
You know what? That's one we would want to hear more about fact specific items. And if you want to email us, we're happy to opine on it. Definitely.
Yep, so whoever else, you can just post your email.
Yeah, our email is on the front page of the handout. So if you want to email us, we'll take a look at it.
Thank you so much for coming, those of you dropping off.
I have somebody who just, I'm sure there was one. Okay. Let's see here. I think we got all the questions that have been in the chat. So,
Okay.
anyone, if there's still one that anyone wants to throw up, I'm seeing a lot of thank yous.
Oh, how
Aw,
nice.
thank
Thank
you,
you.
everyone.
I do hope it was informative.
It looks like we've run through, answered all the questions that were in the chat.
Oh, great.
Wonderful.
Well, here we go.
Just want to thank our speakers very much. This was a great class, always is, and we would love to have you come back again next year.
Well, thank you, Viva, and thank you,
Thank you so
everybody.
much.
Thank you, everybody, for attending and listening.
All right, we will.